Hello, everybody. My name is Georg Ringe. Welcome to this online seminar, part of the Law, Finance and Technology group at the University of Hamburg. We're delighted to have you all here with us. This is a first. We normally do this as a nice lunchtime event where we all come together, but for the well-known reasons that is not possible at the moment. We're still delighted to have a nice group of people together here online, and it's maybe also a new opportunity, nice opportunity to have people from outside Hamburg joining. Aha, Conchetta, hello. I see lots of people I know from outside. That's great. Thanks so much for joining us. A couple of housekeeping rules. So the standard would be that when you're not speaking, it would be great if you could switch off your microphone, because that would reduce the noise. Feel free to have your video switched on if that's something you like to do, because I think it's nice to see people and not see people's reactions. That's at least much better than just speaking to an empty screen. At least that's my feeling. A note, however, we will record this event to make it available also to others. So, bear that in mind when you think about speaking or switching on your video. You may like that or may not like that. Hello, everybody. It's nice to see your faces. Thanks so much for joining us. Great. So let me just say a few words about our speaker today. This is Marco Dell'Erba. It's so great to have you with us, Marco. He is a fantastic young scholar in financial markets regulation. He is Italian. He's been spending a number of years at NYU. And we're great and grateful to have you back in Europe now. So he's now an assistant professor at the University of Zurich, just for a couple of months, right, Marco? Since when? Since last year, I think.
Since August.
August. Yeah. Excellent. So welcome back, and we are excited and look forward to hearing a little bit about your research. Marco will speak for about half an hour about a recent paper of his. The link is on the slide. You just also find it by Googling it. The paper is called Shadow Central Banking, very topical thing. And it would be great if we could save questions for Q&A afterwards. If you have any comments or questions, then feel free to use the chat function in Zoom. So if you experiment a little bit with the software, you will see that there is a chat. You can post any issues or questions there, and we'll try our best then to pick up all these issues in the discussion afterwards. We should be finished in about 1 hour in total, so that leaves us ample time, I think, to discuss these issues. But that's all from me. I now hand over to Marco, who will introduce us to the topic.
So good morning, everyone. Thank you, Georg, for this invitation. For me, it's a primer, both in terms of presenting it with Zoom and presenting this paper, which is part of a broader project that I'm conducting on disintermediation in capitalism. And of course, this is related to technology, but it goes beyond. So let me start from these. I think narratives are extremely important in this context. I started my project from a time zero that I identified with shadow banking that started to develop in 1960s, and then led to the implosion of the financial system as we know it with the development of the financial crisis in 2008. At this point, there were two different reactions. The regulatory reaction, that is something that I defined somewhere else as an endogenous reaction, because we are used to have these kind of reactions by regulators after scandals or after financial or economic crisis. And then exogenous one, there was the technological reaction, with the development of fintech initiatives and spreading of these blockchain technology. The Bitcoin white paper by Satoshi Nakamoto was published immediately after the financial crisis in 2008, and it proposed a new model that would disrupt central banks. And this was kind of the beginning. But then all this went beyond. Bitcoin were applied with smart contracts to primary markets, and ICOs led to the multiplication of cryptocurrencies. Although we're talking about something that belongs to the security world, because ICO tokens are securities somehow, they had an impact on the monetary side. The multiplication of cryptocurrencies was a very unstable context where many problems emerged, and stablecoins somehow tried to respond to the problems that were raised by the instability of cryptocurrencies that couldn't serve as a medium of exchange, as a store of value, and a unit of account, which are the three most important functions of the money. At this point, stablecoins, even more than Bitcoins at the beginning, triggered a reaction of central bankers and governors who were kind of concerned and scared. And I find this surprising because all the promises that stablecoins have, we can find them, and even more at the beginning of this disruption that started with Bitcoin. We could see all these in a different form. We could think about these transformations as an ascending climax, where at the beginning we have technology that then is applied to two different contexts. The monetary one, with Bitcoin and ICO leading to the multiplication of cryptocurrencies, and then ICOs invading the sphere of digital securities and triggering questions in the context of corporate governance. So in a broader network where digital securities could serve the purpose of solving issues like proxy plumbing and etc., and corporate democracy more generally. And at this point, we start thinking about market infrastructures, crypto exchanges, and other clearing houses run on these decentralized platforms start to be more than an hypothesis. And finally, we assist to the disruption at the level of financial networks. Shadow central banking is one of the networks that I consider. Here, I'm considering also other networks that emerged. And if we think about this in terms of layers too, what we realize, we're talking about decentralized finance. And this is a way to think about the way decentralized finance came to emerge and established. So, and you can clearly see the different layers that characterize decentralized finance. They're generally associated with technological discourses more broadly. So what's shadow banking? Very briefly, we all know what we're talking about. It's a network of heterogeneous financial institutions implementing structures based on heterogeneous financial instruments too. Shadow banking connects commercial and consumer borrowers to investors through capital markets. We start, in this case, this chain from assets that are generally liquid and transformed with a credit and liquid transformation through mortgage-backed securities, CDOs, repos, and securitizations, and via the role of money market funds, pension funds, and institutional investors acting as conduits, they reach investors. So this is very briefly, the chain of shadow banking. What were the causes of its establishment? First of all, there was a financial need. This need was a collateral. Collateral in financial transactions has always been extremely rare, and specific causes have led to its scarcity more and more. Regulation was one of these reasons, and we should think about regulation in relation to shadow banking in two directions, in two ways: deregulation and banking regulation. Banking regulation put downward pressure on credit institutions. We know Basel II, Basel III, etc., and forward implementations served really as a tool to regulate liquidity, but at the same time, they increase the pressure and the competition on credit institutions that are to migrate towards a new regulated activities beyond the perimeter of regulated activities. And in this context, innovation played a very important role. As we know, in this case, when we think about innovation, we're not talking about technological innovation, but innovation in the form of financial engineering as a way to increase the risk capacity of the financial system as a whole. Let's briefly move to central banks. This nice picture from Schoenmaker makes clear all the functions of central banks that are engaged in monetary policy, macroprudential and microprudential policies, and also play a role in the conduct of business. We don't have the time to talk about all these, but somehow we will realize how all these things are interconnected when we start talking about payment systems. Let's briefly review in a non-systematic way what central banks do. Well, they have a monetary authority, of course, and they pursue stability in three directions: the value of money, real economy, and financial stability. And they serve, I think, the most important interest, public interest, is the one of maintaining the trust in currencies and facilitating its circulation. When thinking about this activity, we should immediately reconnect to the role of central banks as liquidity providers. Recent examples are the one of quantitative easing with Fed, Bank of England, and the European Central Bank buying tons of government and private corporate bonds, but also swap lines that are a way to think about liquidity from an international perspective, because the 90% of international transactions happen in dollars, so the Fed has an interest in keeping liquidity at the international level. Also, they act as lenders of last resort. Nothing to say about that. Why did I leave out payment systems here? Because payment systems are instrumental to maintaining the trust in currency and facilitating the circulation, but they also serve somehow as lender of last resort and serve as liquidity providers. They are based on central bank and commercial bank money. Central bank money consists in liabilities to be used as money, whereas commercial bank money includes assets and liabilities, capital reserves, deposits, and borrowings. Central bank and central banking activity is generally the combination of the public sphere. If we think about interest rates, monetary policy, this is a tool that central bankers keep for themselves. Whereas there are other activities like maintaining payment systems that are generally delegated to the private sphere. So when I think about private central banking, it's rather different from shadow central banking, because one is regulated and one is not regulated. Also, key characteristics generally associated with central banks. Now we think about central banks in modern times as public or state-owned, but it has not been the case. In the 17th century, the major central banks were private, and during the free banking era, private banks acted as central banks and could issue their own banknotes. And even now, if we think about the Bank of Italy, it's privately owned, and the Federal Reserve is partially privately owned. But the separation between ownership and control in this context serves as a tool that makes them somehow public. Switching from central banking to shadow central banking, here we have to focus on payment system, right? And the role of technology was extremely important, and it's the reason why these private activities escalated in strength, somehow in violence and intensity too. E-money was the first experiment. The European Central Bank defines e-money as an electronic store of monetary value on a technical device used for making payments to entities other than e-money issuer. This device acts as a prepaid bearer instrument, which does not necessarily involve bank accounts in transactions. And these e-money products can be hardware-based or software-based, depending on the technology used to store the monetary value. Smart cards, debit cards are examples of this, and they proliferated during the, I would say, in the aftermath of the internet revolution. Then we have pre-Bitcoin digital currencies. We all remember the Californian movement of cypherpunks in the 90s with David Chaum and other like Timothy May, Jim Bell, and ultimately Nick Szabo proposing some prototypes of crypto currencies. The reason why all this didn't work was that the American regulators were concerned, and also the timing wasn't favorable because all this happened basically during and after September 9/11, yes, in 2001, and American regulators put a veto on all these. And ultimately, we land to Bitcoin and stablecoins. Bitcoin was a new experiment, developing a structure that was capable of disintermediate central bank, where money becomes the input of the system rather than the output, as Kevin Werbeck nicely says. The main idea was to provide an alternative payment system, creating a new form of trust based on decentralized consensus and secured by cryptography. As I said before, it's astonishing that at this time, central bankers didn't really care that much. Bitcoin failed in becoming a unit of account, medium of exchange, and most of all, store of value because of its intrinsic volatility. Stablecoins try to solve these issue. We know 3 categories of stablecoins. You can find this in a paper of mine that I published last year in New York Journal of Legislation and Policy. But basically, very briefly here, we can say that there is a first fiat currency asset-backed stablecoin that is not decentralized, so is fully centralized. Tether is one example of this. Then we have decentralized stablecoins and algorithmic stablecoins that are the ones that can modulate the supply of money through a decentralized structure based on smart contracts. We have different examples with different purposes. We always heard about JP Morgan coin, Libra coin, but never, very rarely, at least this is my perception, we heard about Hedera Hashgraph, that is a new consortium where Google is highly engaged. So the idea of this is to have what the people call the Sangreal, the perfect cryptocurrency, serving as a medium of exchange, store of value, and unit of account. And if we couple of all these functions, we realize that we're talking about something else beyond financial services, beyond the banking system. We are trying to talk about a superior layer, which is the one that I call shadow central banking, which is a network of heterogeneous institutions adopting, even in this case, heterogeneous instruments such as stablecoins that by nature are extremely heterogeneous because they could be qualified as money market funds, as derivatives, as commodity, whatever you want to define, there is a stablecoin. They disrupt the highest layer. If you think about the idea of Minsky's pyramid, we're talking about the peak of the pyramid. And what is fascinating here is that shadow central banking disrupts both public and private central banking activities. As I said before, money supply is an activity that was clearly always in the realm of modern central banks. And here we observe a transition, or at least an attempt of a private actor to become a money supplier, a dynamic money supplier, reacting to exogenous facts. And also, we assist to the disruption of the private sphere, because we're, by the way, talking about payment systems, right? Here, these private actors are trying to connect commercial and consumer individuals. Here, I try to echo the definition of shadow banking, where transaction and money exchange happens on a peer-to-peer basis without relying on a central bank. The reasons behind all these are, at least the way entrepreneurs try to justify all this is increasing transparency, talking about financial inclusion, and determine a structural disintermediation. Is this a new paradigm? Are private banks a novelty? Private central banks a novelty? No, I would say no, of course. And money value, depending on reserves, as in the case of stablecoins, is it a novelty? Well, no, it's not at all a novelty. It dates back to the gold standard that when before the full faith and credit, gold standards served the purpose of granting the value of money. So we're not entirely talking about something new. Bitcoin, on the other hand, is different because it's not backed by physical reserves. There are some similarities that I identify, that I see between shadow banking and shadow central banking. First of all, they are both networks with a cross-border vocation. And this cross-border vocation, as in both circumstances, a very strong geopolitical, triggers very strong geopolitical questions, both in terms of protecting the financial system, the financial activities, and the financial monetary system from foreigners or not regulated entities trying to invade a specific space and a specific jurisdiction. So, and like shadow banking, we assist here to an invasion of activities that are performed by regulated institutions. In that case, credit institutions, here, central banks. I find fascinating also the fact that the causes may be similar. Here we observe that in the causes there is a need for a specific good. In that case, we were talking about collateral. Here we're talking about an instrument that would allow individuals to perform transactions in a very fast and transparent manner on a cross-border basis. Regulation in the forms of lack of regulation had an impact, because if we think about the establishment of this network, we cannot think that all this happened because regulators were late and often underestimated this until, as in the case of ICOs, they had a very high capital market capitalization. Competition is the same here. We are, by putting downward pressure on payment systems, we are trying to compete with established institutions, both private and central banks. And innovation here becomes technological innovation coupled with financial engineering. So there are two layers, technology and financial engineering, that are coupled and then that really serve as a common basis for developing this new financial network. Which are the problems? So, first of all, which approach should we use? I still don't have an answer for that. should we elevate shadow central banks to the rank of central banks? And in this way, are we normalizing the role and the importance of central banks at the same time? Well, it's very hard to do something like that, and probably it's complicated. Another alternative would be to think about to regulate these shadow central banking entities as simple market infrastructures. But here I noticed something that struck me. Central banks are in charge of money supply, but they delegate the maintenance of the infrastructure to private actors. Here, in the context of stablecoins, of global stablecoins, we assist to the issuance of money coupled with the maintenance of the infrastructure in the same entity. So this is probably a reason of concern for me when we think about regulating all these entities as simple market infrastructures. And there are many concerns that are more specific at the level of corporate governance and systemic risk, and then I come to the conclusion. At the level of corporate governance, there is always a problem of accountability and independence. These are two main problems at the level of central banks, and they are a tool to mitigate the risks emerging from accountability and transparency. I made a mistake in the slide. As a tool that would mitigate central bank independence. Accountability is a very strong problem. The first version of the Libra Association was based on an entity that was in charge of economic, technical, and organizational tasks with no mechanisms of accountability, opting for a corporate form, for an uncorporate form, as the one of the association based in Geneva, that wouldn't even leave spaces for the mechanisms of accountability of traditional corporate governance. And then independence here, when we talk about private central banks, independence from whom? We're not talking about different branches of the government. We're talking about probably different activities. That's why I talk about the possibility of thinking about a Glass-Steagall Act that would regulate the independence of this entity. And opaque corporate governance is a very strong reason of concern. Here, I quoted the Hedera-Ashcraft white paper. Swilders enjoys the distinguished status of being a permanent member within the governing council. The governing council is one of the structures, because it is the creator of the algorithm underlying Hedera's infrastructure. And it's a Delaware incorporated company created in 2015 with 3 million and 2 main investors. So is this transparent? Is this an improvement of the system? I don't know. And finally, if we think about the problems of systemic risks, there are problems related to reserves. Do they exist? In the context of Tether, the problem was that Tether, if we talk in terms of money market funds, it broke the buck because there were no reserves granting the $1 value of each stablecoin. So in that case, and it's the most capitalized stablecoin, are they liquid enough? After all, central banks are liquidity providers, especially under critical conditions as the ones that we are living now. And a problem, a systemic risk problem, as well as a corporate governance problem, is how these reserves are invested, and what kind of incentives do these people have to invest in highly liquid instruments. The echoes of the shadow banking system emerges even here when we talk about systemically important financial institutions. We immediately switched from too small to care to too big to fail. too big to regulate. With the G20, with the IOSCO now, talking about global stablecoins as an issue that could trigger problems at the level of financial stability. And finally, thinking in classical terms of liquidity providers and lender of last resort, there are two problems: a technical dimension and the problem of interest. The technical dimension is that there is no lender of last resort behind Bitcoins. So this is one of the reasons why the people are pessimistic about the establishment of a new order based on these cryptocurrencies. And then the other technical problem is that they are based on a fixed supply. What would I do? Would I mine gold or would I mine Bitcoin to react to a emergency, to a liquidity shortage? There wouldn't be time, right? It would be impossible. And then there's a problem of interest. Why should I be a lender of last resort if I'm a private entity? What kind of incentives would I have? And that's the reason, after all, why I respect Hayek's, of course, approach, but I am kind of pessimistic also in light of the negative experience that came out from the free banking era, which is basically the only test that we have to verify whether competition among private banks functions. And in that context, it didn't work because they couldn't grant par value exchange between the different nodes that they were trying to issue. So with this, I think I can conclude. If you want me to say briefly something about COVID here and then opening to the floor, 2 minutes, or I can stop here. Up to you.
Great, thank you. Yeah, Marco, I was waiting for COVID-19. Interesting
to
have these times of presentation.
Of course,
mentioning it.
We need to start emails saying, "I hope you're healthy," and we need to insert a slide on COVID-19 in presentations.
Maybe it's a good idea to start the discussion first, and then as we are emerging, maybe you can say something about COVID.
Okay.
Along the way, would that be okay? Yeah.
Perfect.
Okay, just for everybody, this is now the opportunity to discuss some of these very interesting thoughts that you've developed, Marco. I propose that we do this a little bit in a moderated way, because otherwise everybody will shout and scream at the same time. So it would be great if you either send me a quick message in the chat that you have a question, or you raise your hand. I think Zoom has a raise your hand function somewhere as well. I don't see where it is at the moment, but so there's several ways, or just physically raise your hand on the screen. That's the old way of doing it. I think Concetta, right, you came first. Go ahead.
Thank you. If nobody else raises his hand, like me, I was the quickest. Thank you for this very interesting presentation.
Thank you.
But I have more than one doubt, to be sincere, after your presentation. The most one doubt about your analysis. The most important one is that you put in the same basket Bitcoin has with stable coins. And in my opinion, they are two very different things. We can consider that Bitcoin, this is a personal opinion, of course, but there is a lot of people thinking like this, that Bitcoin is not at all a currency. meaning that it can be used as a means of payment, one of the main functions of money. But we can discuss this point. While stable coins are completely different, because stable coins like Libra, but Libra decided just yesterday or 2 days ago probably to not go on with these experiences, considering all the difficulties encountered to start the project with the regulatory authorities making impediments, but we should see what happens in the future.
Mm-hmm.
And stablecoins are different because, of
Absolutely.
course, you have a basket of reserves under stablecoins. So, this is a means of payment in a classical theory, under the classical approach, but of course is something very similar to bank money. One point that I don't understand, why you consider central commercial bank money including capital reserves?
Yeah, I
normally under classical, the classical idea of commercial bank money is that it is equal to their deposits, no more than the reserves. Okay.
Yes. Yeah.
But these are two very different tools, and so according, in my opinion, the regulatory problems they pose are very different. And
completely, I agree with you. I agree with you.
Should be treated very differently. Another point that I don't clearly understand, which is your main question? Which is your main question? Are you afraid that these currencies can create problems of trust of people in these new instruments? The trust in the capacity of using these currencies as it is able to do a central bank, because this is you started from this point. Central banks are very useful mainly because they can ensure the trust of people in the capacity of using these currencies for their day-to-day negotiations, no? This is the main goal of a central bank. Are you afraid that this kind of currencies are, if we may use this name, because it's not both are not money in the proper meaning, in my opinion. Are you afraid that without a central bank we cannot have the same result? Which is your main question about? What are you afraid, or you are happy that there is competition?
Thank you for the questions, especially the second one that I really like, because it helps me to point out something. My question at the very beginning was, technology was trying to be a reaction to the financial crisis, and notably to somehow shadow banking, increasing transparency, increasing trust, and at the same time solving problems of trusts at the level of centralized institutions such as central banks, by adopting a very critical approach as the one of Hayek developed in the 70s. So my question here was, is all this system going towards something different? Is it a line of evolution, or is this line of evolution is becoming rather a circle, coming back to the main point? So starting from shadow banking, are we going towards that same, towards a system that has the same rules, or is it something different? And I analyze this at the level of pure central banks and shadow banking in something that I didn't present today. So this is my main concern. I'm concerned that competition at the level of cryptocurrencies, if it's something similar to what economic systems experienced in the free banking era, wouldn't work. I'm very skeptical about this, and I'm also skeptical about the conflict of interest that private currencies may raise. But these are really two different approaches. There are those central bankers that would favor increased competition between private actors and those who don't. I'm very skeptical about this. To answer to your question about Bitcoin and stablecoins, I totally agree that they are two different animals. I'm not treating them as a similar entity. I'm putting as two similar entities. I'm putting them not in a basket, but in a consequential line of evolution. Stablecoins try to solve specific problems that emerged in traditional cryptocurrencies. And Bitcoin, one of the attempts of Bitcoin was to be used as a medium of, as a payment system, but it didn't work. It didn't work. At the beginning, somebody paid 10,000 Bitcoins for a pizza. Let's not forget this. So there was a real ambition to be a medium of exchange. But then specific speculative trends and the scarcity of Bitcoin made all this extremely complicated. Now, if we have to talk about Libra, there is a lot to say about this. And just let me share my screen. Let's go here. Do you see me as a slideshow or, yeah, cool. Okay, version 1 versus version 2. Version 1, as you said, was a global payment system that was backed by a basket of national fiat currencies. So Libra coin was a composite coin backed by a basket. So of course, this is enough to say that this is different from Bitcoin, but I didn't make any assimilation between the two. Version 2 is something extremely different. It's trying to become a global platform. So that's why it applied as a market, as a payment system, as a market infrastructure. And this global platform encompasses different coins. Libra coins, in this context, don't mean anymore that global payment coin that was backed by a basket of national fiat currencies. Here, it identifies two different categories. Single currency stablecoins, so Libra dollar, Libra euro, Libra pound, and a residual multi-currency coin that is implemented in those countries that will not have a central bank digital currency. And this part of the Libra project, by the way, is the one that still strikes me and is not that different from the global payment system of the first part. And it exposes those poorer countries with poorer financial systems and poorer currencies to the disruption of these private entities. So of course I agree with you that nowadays talking about Libra doesn't mean anything anymore. We need to refer to version 1 or version 2. So by referring to accountability, to the problems of accountability, I'm referring to the problems that especially emerged in the version 1. Somehow they tried to solve all these problems, but if you read this, if you read version 2, you will realize that there are other priorities, but not the one of accountability and not a big step forward in terms of increased corporate governance. And this, let me say one thing about swap lines, is a reason of concern for me. Swap lines solve liquidity problems between the Federal Reserve and very healthy central banks. I don't think that the Federal Reserve would negotiate a swap currency with a, I don't know, a third world country. If this third world country don't have the liquidity coming from swap lines, don't have sufficient financial instrument, sufficient healthy financial system to issue government bonds to finance their activities. So they are a great target for this multi-currency coin that is supposed to be a neutral, as they say somewhere here, I reported, a neutral and low volatility alternative that could ensure users in such regions that can benefit from accessing the network and increase financial inclusion. So I don't know if I answered to your question. I could go on for 30 minutes. It's fascinating. So thank you for the question.
Thank you for that. I think I have other people to ask questions, so maybe we should move on a little bit. So
thank you.
Next on my list is Anna. Would you like to come in and ask your question?
Okay, just a question. I don't know, maybe there is a little bit of confusing in using the name, because shadow banking is actually what we define according to the FSB, that now has been also rephrased in terms of non-bank financial intermediation, is basically a credit creation, that in this case we don't have it, okay?
Yes.
So, yes, so basically maybe using this term of shadow central banking, even though I kind of understand the underlying reasoning and also the clarification that you just made, might induce some confusion. You know, might induce some confusion with the shadow banking and shadow central bank. So if you want to reinforce this concept, I think you should really make clear at the very front this big distinction. Otherwise, we don't capture, as also Concetta was stressing, which is the major concern of your story.
Yes, absolutely. I forgot. I was in a rush. I cannot see you, but I think you're somewhere.
I can show you myself.
No. I am lost with Zoom. I didn't make this statement at the beginning. When talking about shadow banking and shadow central banking, I'm not really referring to credit creation. It was rather a way to think about two different phenomena developing at two different levels, sharing, however, similar dynamics at the level of the causes that triggered these structural transformations, and also risks that may be similar, especially when we think about systemic relevance of all these and interconnection. So I didn't make this point at the beginning, so I apologize for that, but it was really, I fully agree. Whereas what I'm studying now in the context of pure shadow banking applied to crypto economy, there we assist to credit creation at the level of crypto economy. But here I was really trying to understand, after we assisted to the disruption of primary markets, corporate governance, what's next? Next, there is the disruption of financial networks, which is financial system and central banks. And that's what I'm doing now. This, as I said, is one part of the research. Thank you. Thank you.
All right, thanks so much. Next on my list is somebody called Nancy. Would you like to ask your question? Hello? Nancy, are you there?
Hi, can you hear me?
Yes.
Hi.
Thank you.
Okay, great. So yeah, it was actually just a follow-up to the first question. So I'm also wondering that how all those non-traditional currencies that were introduced, for example, like virtual currencies, crypto, stable ones, are linked to the traditional fiat currencies and the governmental reserves. Because as what you just mentioned, Libra is actually linked directly to a basket of those fiat currencies, while Bitcoin isn't. But then later on, because as far as I know, like some of the Asian governments are actually considering holding Bitcoin as well. And does that make a difference? Yeah.
The question is not clear to me. Were you talking about the Asian?
I just wish to hear you like elaborate a little bit more on all the currencies that you introduced, and what are some of the differences, or like some different shades of
No, I mean differences are huge, especially when we think about what is baking what. And in the context of Bitcoin, there is no, as I said, there is no lender of last resort. They don't implement, by the way, price stability, but Bitcoin is based on a systemic stability, which relies on different logics and different mechanisms. There's something very nice by Caitlin Long that was published. A very nice newspaper article, magazine article. They're totally different. And even when we talk about stable coins, not only comparing stable coins with Bitcoin, we realized how they are different. Remaining in the field of stable coins, we assist to huge heterogeneity, because there are stable coins that are backed by physical assets. There are stable coins that are backed by digital assets. There are the ones, as I said, fully decentralized, that in theory should be more transparent. And finally, we have algorithmic stable coins that do not rely on any reserve, they are not backed by anything. And so making this clear, then when we talk about when we compare stable coins and Bitcoin, what are we talking about? They are completely, stable coins themselves are completely different, so it's very hard to make a comparison. What I could say probably is that, as Professor Breshamar was saying too, we could observe some migration of stable coins to the medium of exchange function, and the Bitcoin to the store of value function, probably. And so from the perspective of the economic function that they would serve, I wouldn't compare them. However, I still believe that it's important to put the two things in a relationship, because the volatility that emerged in the Bitcoin was a reason of concern at the level of mechanisms in crypto economy. Now, another thing about Libra version 2 that probably could answer your question more broadly. Who are the new competitors of this Libra 2.0? At the beginning, with the global payment system, we were clearly comparing fiat currencies with Libra coin. Now that this Libra is becoming what Philip Sandner defined as a global platform, also we have to rethink about its main competitors. That could be very heterogeneous. It could be a central bank digital currencies issued by China that was adopting a very similar structure as Libra version 1. We could think about Ethereum platform. If this Libra is becoming a global platform, probably Ethereum is a competitor. So now it's also very hard to think where we are going in terms of who is trying to disrupt whom. Whereas at the very beginning, with the version 1 of Libra, it was clearly to me that it was a strong tool to try to disrupt central banks. I don't know if I answered to your question.
Great. So I give the floor to Cheng Yun San. Are you there? Would you like to ask your question?
Yes, yes. First of all, thank you very much for hosting this wonderful event. Otherwise, we won't be able to join this online.
Yeah.
Otherwise, we have to travel a lot. And I have a disclaimer.
Crisis.
Yeah. And first of all, I'm not in any kind of resort. It's simply a virtual background. Everybody can try that using Zoom. Okay. I have. Well, by the way, it's a wonderful presentation. I have a couple of questions.
Thank you so much.
And first of all, I was interested in your ideas, or I mean, point of view, in terms of, do you think if there is really a shadow central banking, then are we going to need a shadow central banking governance? And if the answer is yes, which institution is capable of doing that? Would that be some kind of mechanism employed by decentralized financial technologies, or through the use of supervisory technologies and smart contract code? Or which institutions in your mind is in a position to conduct this job? That's my sort of first question. The second one is, looks like, it at least appears to me, even though we have this shadow central banking context, we still have the typical or traditional central banking, right? Yeah. So looks like we will be living in a parallel universes where we see digital representations of values travel in between, and in particular in the forms of fiat currencies and digital currencies or cryptocurrencies, right? Yeah. So how do the shadow central bank governance and the traditional central bank governance work together to ensure financial stability, while the digital representation of values are traveling in between these two universes? Yeah. Those are my questions.
This question looks like a novel from Isaac Asimov, probably, but it's a bit. No, thank you very much for your question.
Maybe we can have a quick
answer. Yes, absolutely. So if we think about the corporate governance of this shadow central banking, I only have one answer. We should exclude the possibility that there's only one infrastructure that will run all these activities. A big failure of this has been, of these systems has been the fact that we cannot rely on one infrastructure. Also, the multiplication of the infrastructure makes difficult the coordination, the interoperability of the different platforms. So it's very hard to conceive a corporate governance. Your question on shadow central banking and traditional central banks, I love this question. I truly believe that a government without the traditional tools that are in the hands of a strong monetary policy could rely only on issuing debt, basically. And at this point, who would buy this debt? We only have to hope that private deep pockets who were not touched by an exogenous shock have the resources to buy this debt and therefore be in the position to funding the economy. And this is very hard to imagine for me, and it's a reason of concern. I think it would be very hard to think about coordination between central banks and shadow central banks in this way.
Great, thank you so much. I'm afraid I have to cut this discussion short because we are at time. I have lots of questions myself, but I have the privilege of having direct access to the speaker, so I think I can raise them directly with him. In a normal physical event, we would now say, you know, now let's have some lunch or something. We can continue the discussion in a cozy environment. Unfortunately, we cannot offer that online, but I'm sure this event has been a very nice way of thinking and getting together about those different things. It's been great to have you with us, Marco, and allow me just a personal comment. So I've been fascinated by this approach. I think it's a great way of thinking about the problem. The notion of shadow central banking is not just nice and catchy, but I think it offers some interesting insights that I hadn't been thinking about before, even though some people had irritations, and of course every comparison has its limits, and the notion of shadow banking itself is somehow has a pejorative connotation, doesn't it? Because it's people escaping from regulation. Whereas in central banks, the world is very different. And in fact, the Fed originally was a private institution.
Absolutely, yes.
An association of banks coming together. So there's some interesting ways to explore. And I think we should say that we continue this discussion, continue this dialogue. We look forward to seeing your paper in print, and we hope that you've taken something away with you from today's discussion. Thanks so much for joining us here today.
Thank you very much for the opportunity, for the great questions that I got from the floor. It was a pleasure to interact with all of you. Thank you so much.
So final word to everybody, please do continue following us. There is a good website at the University of Hamburg on law, finance, and technology. We have future events in May, towards the end of May, I think the 26th of May, we'll have Guntram Wolf, the director of Bruegel, the think tank in Brussels. He'll talk about cybersecurity and technology. So that's the event to look out for. And I hope that at some point in the future, we will go back to physical events. But for now, this was a very pleasant experience. And on the upside of it was to have many people from outside the region joining us. Thanks so much, and hope to stay in touch. Thank you.
Thank you.
Bye-bye. Thank you so much.
Bye.
Bye. Bye. Bye. Bye.
Thank you. Thank you. Bye-bye.